Welcome back to Stock School Daily.
So the analyst kept an outperform rating, which is basically a buy, but, and this is the key, they technically cut the price target from $484 down to $403.
$100 shaved right off the top.
Yeah.
I mean, that sounds like bad news, doesn't it?
It does.
But here's the kicker. This is where it gets really interesting for you. The stock price, when the report came out, was hovering around, what, $170.91?
Right.
So even with that cut target, the potential upside is still a staggering 135%. So why the cut? If the upside is so huge, why even bother adjusting the target down?
And that's the critical point the analyst is hammering home. The adjustment was really just an accounting measure. It was driven entirely by all this external market noise and political stuff, not because anything was wrong with MicroStrategy's actual strategy.
So they were just acknowledging the volatility out there.
Exactly. They're seeing the turbulence in the sector, but they're not saying it's a real long-term risk for MSTR itself.
Okay, let's unpack that turbulence then, because the report gets very specific about where the fear was coming from. We need to look at what was happening in Washington, D.C., what some people are calling the Trump factor, that, spooked the market.
The report pointed to two big political proposals. Both were aimed squarely at the traditional finance and credit card world. First, you had the big one, the proposal for a 10% APR cap on credit card interest rates.
A 10% cap, wow.
Yeah. And second, there was the endorsement of the Credit Card Competition Act, the CCCA.
We've heard that acronym, the CCCA, but for our listener, what does it actually do? Why is that such a lightning rod for the banking sector?
Well, the CCCA is a big deal because it's designed to break up the duopoly held by Visa and MasterCard.
The two giants.
The two giants, yeah. It would force the big banks to offer at least two network options for every credit card transaction, and importantly, those two networks can't be the same one. The idea is more competition, but the financial hit is obvious. It cuts into those interchange fees.
Ah, the fee they collect every single time you swipe your card.
That's the one. So both of these things, the APR cap and the CCCA, are a direct attack on the profitability of traditional banks and credit card processors.
Okay, so that explains the fear.
Precisely. And the report notes the market reaction was immediate. It triggered what they call instantaneous algo selling.
Automated trading.
The most powerful and indiscriminate kind. These algorithms, they don't read the nuances of MicroStrategy's Bitcoin strategy. They just scan headlines for keywords about regulations affecting financial services or fintech.
So MSTR, which is just a Bitcoin holding company, it gets tagged by these algos simply because its ticker lives in that broad financial ecosystem.
That's it. They can't tell the difference between MicroStrategy and a regional bank.
And that's the paradox right there.
It's the core of it. The report shows MSTR got swept up in this selling wave because of a keyword problem. The analyst makes it super clear. These banking regulations do not impact MicroStrategy's fundamental business, which is just holding Bitcoin.
So it's just noise.
All noise. It created this huge temporary discount. The price target cut was just adjusting for that immediate volatility. It was like them saying, yep, we see the political storm, but our actual thesis is still solid.
That really puts that target cut into perspective. It was a complete head fake. So if the short-term stuff is just political noise, let's get into the real meat of it.
Yeah.
The three long-term drivers that the analyst thinks justify the stock more than doubling to $403. Let's start with Catalyst A, the institutional green light. What's supposed to happen by 2026?
The big move here is towards comprehensive regulatory clarity. Right now, for a lot of the big institutional players, the ones with massive fiduciary duties, Bitcoin is still kind of the Wild West.
A bit risky.
Very. So the analyst sees this shift coming around 2026, where major governments finally nail down the accounting rules, the custody requirements, all the market structure stuff for digital assets.
Okay, but why is that clarity so important for the heavy hitters the report talks about, like pension funds and sovereign wealth funds? I mean, retail investors have been in this for a decade.
It's because institutional money plays by a completely different set of rules. They don't just need to believe in the asset. They need a clear, compliant pathway to hold it.
A pathway, right.
Think about it. A pension fund manager can't just, buy some Bitcoin on a random exchange
And stick it in a cold wallet, yeah.
Not a chance. They need audited financials, they need clear FASB accounting, regulated custodians, and they need board approval, which almost always requires proof that the regulatory landscape is stable.
So how does MicroStrategy solve that puzzle for them?
MicroStrategy is the compliant on-ramp. It's publicly traded. It basically functions as the ultimate Bitcoin proxy. So for a huge institution that wants Bitcoin exposure, buying MSTR stock is just. It's so much simpler and more compliant than trying to handle custody and taxes for the actual digital asset themselves.
So as the rules get clearer, Bitcoin shifts in their minds. It goes from a risky bet to something more like
established digital gold.
Yeah.
Exactly. It becomes a necessary part of a diversified portfolio.
So MSTR doesn't just ride the price of Bitcoin up. It benefits because it's the easiest vehicle for billions of institutional dollars to even get on the ride in the first place.
That's it. It's the cleanest way for big money to check that regulatory box, and that clarity is the biggest multi-year driver behind that $400 target.
I get the institutional argument, but let me push back a bit. Isn't relying on regulatory certainty by 2026 a little speculative? I mean, couldn't the government just drag its feet or complicate the rules, leaving MSTR stuck with Bitcoin's volatility, but without those big buyers showing up?
That's a really important question. It's about timing versus trajectory. And, nothing's ever guaranteed. But the Analyst's thesis is really based on the speed of institutional adoption that's already happening.
Okay.
And the economic pressure to clarify these rules is just getting stronger, especially now that you have regulated products already out there. So yeah, the risk of a delay is real, absolutely. But MSTR is so highly leveraged to Bitcoin that when that money does come in, the move will be explosive.
So the bet is on the direction, not the exact arrival date.
Precisely. Trajectory over guaranteed timing.
Fair enough. Okay, let's pivot to Catalyst B. This is about new revenue and retail users, specifically the prediction market boom. This feels less about big institutions and more about grassroots growth.
That's right. This is looking at the ecosystem from the ground up. Prediction markets. So this is where users can bet on real-world outcomes, like who wins an election or what the Fed will do with interest rates.
Or sports, even.
Yeah, sports championships, things like that. They're becoming a huge new growth engine for these big crypto-adjacent platforms.
And the report specifically calls out companies like Robinhood, Ticker Haze, and Coinbase, CoinIN. Why is this feature suddenly such a big deal?
Because it solves a really key problem for them, user engagement, or, well, lack of engagement. Millions of retail traders just walked away from crypto after the last peak.
They got burned out.
Totally. Prediction markets are super sticky. They give people a different reason to open the app than just watching a coin go up and down. It's a high-frequency, high-engagement tool to bring old users back and, maybe more importantly, to get brand new users in the door.
So it's not like prediction markets directly help MSTR's balance sheet. It's more of an indirect effect.
It's a ripple effect. That's exactly it. The core idea in the analysis is that when you see higher retail activity on these crypto apps, it's almost always correlated with a bullish move in Bitcoin's price.
More users means more capital, more trading.
More capital, more trading volume, and yeah, usually more of that speculative money rotates into the blue chip asset, which is always Bitcoin.
That's a really powerful indirect mechanism. So MicroStrategy benefits because millions of people are drawn back in by this fun little feature on Coinbase. The whole ecosystem gets healthier, and MSTR is the stock with the most leverage to that growth.
It's organic demand generation. MSTR doesn't have to spend a dime on marketing for it.
Okay, let's tie this all together now with Catalyst C, the fintech rotation. We started this whole deep dive talking about those DC proposals, the APR cap, the CCCA, and how they were hitting traditional finance. So where does the analyst think all that money is going to go?
Well, if you look at the big picture, the analyst's view is that capital is, well, it's efficient. It's not going to just sit around in sectors that are facing shrinking profits because of government policy.
It's going to find a new home.
It has to. The pressure on traditional banks and credit card companies creates this huge incentive for capital to rotate out of old finance and into new finance sectors that aren't so constrained.
And who are the main beneficiaries of that rotation?
The source material is really specific here. The immediate winners are alternative lenders. Think buy now, pay later firms like Affirm, AFRM, or SoFi.
SoFi, yeah.
Why them? Because they operate under different and frankly less punishing regulatory rules than traditional credit cards when it comes to rates and fees.
So a headwind for Visa is a tailwind for Affirm. I get that. But why does that rotation have to include crypto and MSTR?
Because when big money is looking for growth, for unconstrained margins, the crypto infrastructure, and by extension, MicroStrategy offers the absolute highest growth potential in that whole new finance world. The government's goal might have been to curb bank profits, but the market's reaction is to find the highest return with the least friction.
And MSTR is positioned as what? The king of that new world.
That's the exact phrasing. The analyst calls it the king of new finance asset in this new environment.
If you found this helpful, hit that like button and subscribe for more.